Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is co-author of Prosper, How to Prepare for the Future and Create a World Worth Inheriting. He also co-created the Crash Course, which is something that woke me up when I was just a stockbroker and the 2008 financial crash happened and I wanted answers. And he runs the website Peak Prosperity. Chris Martenson, thank you for joining me again.
Jason, it's a real pleasure to be back with you.
Yeah, I'm excited to talk to you again, Chris. I always enjoy your views. You put out such good content with the guests you interview.
Thank you.
Now, Chris, I want to ask you about the rally in gold and gold stocks since December. Since the last time you were on, we didn't have a rally in gold and gold stocks yet. It had just started. So why do you think we've had such a strong rally in gold and gold stocks since December?
Well, it could have something to do with 13 trillion in negative yielding debt across the world. Negative interest rates should be a pretty strong catalyst for gold. But I have to tell you, Jason, I think what it comes down to is sort of the opposite of the title that Grant Williams had on his excellent gold piece that came out a little over a year ago. He called it Nobody Cares. And what he was pointing out was that gold as an investment in Western circles was just nowhere to be seen, right? It wasn't on any pension fund statements. It wasn't really in any endowments. Not many people were holding it. You know, a couple crackpots like us and maybe a few of the major hedge fund types who saw really where this was going. But the truth was nobody in the West cared. The Treasury Department is on record as saying, we don't care if gold leaves the West and heads to the East. We don't care. And so I just came back from a wealth conference where some of the wealthiest people in the world hang out. It's in Newport. It's a yearly event. Great opportunity to find out what they're thinking. And I got to tell you, gold is suddenly appearing on more and more radar screens of people who manage money, and especially people who manage big money. So I really think that the time for gold is come, and we have a lot of constructive elements out there for it. Negative interest rates are one. But it's this shift in sentiment that the reason people were constructive on gold at this wealth conference was not because they particularly want gold or not particularly because it had risen recently, but because it is now becoming accepted as self-evident that there's going to be an extraordinary set of difficulties coming from all this money printing, and that the Fed and other central banks have really overdone it this time.
Do you think a lot of the more mainstream people that maybe had confidence in central banks in the past, do you think that confidence has been eroded based on the discussions you've had with some of those wealth managers?
Absolutely. And it's not just to give you an example of one of the people that spoke at this thing, Lawrence Lindsay. He was a Fed governor for 8 years from back in the 90s, and very tapped in, hangs out with that crowd. He couldn't have been more dismissive of negative interest rates and of the general policies that the Fed has pursued in other central banks. He called them insane. He says they end badly. He thinks NERP, it lacks all common sense. He thinks it makes academic sense. He's worried that there are too many academics in these positions doing their little academic tap dances that involve some odd combination of bad thinking and egos that combine into really ridiculous policies. So when you have former deep insiders looking across the landscape and just saying this whole thing is rubbish, that's where we really are in this story at this point in time. And so for anybody who still has faith in the Fed at this point in time, I'm going to suggest that either they haven't really studied what the Fed has been up to very closely and don't understand what's happening right now, or they're blinded by faith. And I get it, faith that hopefully this all won't fall apart in some really awful way. But I think, Jason, for people who look at this, study it, really know what they're talking about, you have to understand that negative interest rates in the tens of trillions of dollars is not a financial experiment. It's not even a monetary experiment. It's a social experiment being conducted by people with zero appreciation for or training in social studies.
Yeah, and yet we have the stock markets in the U.S. that haven't crashed yet. I mean, they keep going up. The economic data, which you were a scientist, and the data appears to be lying, cherry picking with data, with statistics and formulas. But yet the stock market just seems like every time the bank stocks in Europe are about to crash, something comes in and there's just stuff on the charts. You interviewed Eric Hunsater. That was a great interview. There was damage on the bank charts like Deutsche Bank and the banking indices that normally on a regular stock chart would take weeks, months, maybe a year or more to repair this technical damage on the chart. And intraday, it's got, just an enormous reversal pattern on it. It's just unexplainable from if the market was functioning normally.
There was a Market Watch column. Wasn't that great. The title was better than the article, but the title essentially, to paraphrase from memory, was the question isn't are markets rigged, but how rigged. And so we are all familiar with the actual rigging that goes on, which, when you cram the price of money to zero, that's a form of rigging. When you manipulate interest rates, that's a form of rigging, directly of bonds, indirectly of stocks through the so-called dividend multiplier effect or something like that, right? But the question now becomes how much are they actually rigged intraday and within individual shares, all of that. And as you mentioned, we see these really bizarre behaviors cropping up all the time now, where especially when a certain level of weakness is breached, particularly in a critical industry or sector or maybe across an entire index, we don't get any sort of basing consolidation patterns as that news is digested. We get what I call nipple bottoms, just these, it's just a straight reversal in the other direction that comes out of nowhere. And so, listen, I back up and I say, look, we had two scares recently. We had the January lows and then we had Brexit. Both of those had these strange, anomalous nipple bottoms. Both of them characterized, Jason, by two things. Stocks powering to all-time new highs, bonds powering to all-time new highs. Listen, this isn't a risk-on, risk-off Jello moving across the plate story. This is a massive wall of liquidity coming in and buying everything. And that's the game right now. And if we wander out of the financial sphere into other spheres, you can begin to appreciate why people voted for Brexit or the appeal of populist candidates who are beginning to point the finger of blame and say, are your lives hard? Well, yeah, let's get angry about that, because guess what? Those rescues, yes, they prevent the markets from falling, but they also suck the economic oxygen away from everybody else. And everybody else votes. Everybody else goes to the store. Everybody else is out driving on the roads. We're the ones who are getting mad and getting reamed by all of this. So the tone-deaf nature of the financial authorities and the monetary authorities in continuing to insist that jamming markets higher is the right course of action is actually, again, to get back to sociology, that is a dangerous social experiment to be running, because that is deeply unfair. It makes people angry, and it should.
Yeah, it's the Cantillon effect. Did you actually see the Bank of England's press release that they put out June 24th, right after the Brexit vote, talking about how, they had to put in at least 250 billion pounds worth of emergency liquidity, talking about, we recapitalize the banks, but we have to put in this liquidity in case of errors and problems and all these things. It's just amazing. Most people probably didn't even notice or read the PR statement.
Yeah, no, listen, lots of reliquefations going on, and chief among that, that 250 billion is nice, but that's just a few months of what the ECB is up to, and they're buying every corporate issue out there right now, no matter how trashy. It's been some of the greatest front running available. There have been bond issues, Jason, that have gone up over 30% in a month, right? Because the ECB is out there buying them. They claim that they're just going to hold all this stuff to maturity. They can't lose, but guess what? The taxpayer will end up paying for all of this. And guess second what? It'll turn out that record profits have been earned by all the people who are feeding at the trough. This is the financial universe. It's disgusting.
How do you think all this liquidity currency swaps, are these going to be taken away when the U.S. loses partial world reserve currency status, when the petrodollar goes? Are these things going to be going on for years and years and years? Do you see anything in your research that shows definitively maybe what takes these things away from the central bankers?
No, it's really, we're down to a confidence game. So the most important thing here is that people keep their confidence in the central banks. You started this whole interview out by asking if that, in an indirect sense, is that confidence being eroded? The answer is yes. Look, they're printing money out of thin air and attempting to buy prosperity. It doesn't work. Everybody knows that. It's in all the data. It preferentially enriches some, but it's a zero-sum game. So the only other question is, who does it take from? We're seeing the from side of the story and the angry electorate. That's going to continue until that breaks. Is there a math model? No. I mean, let's be clear, Jason. Japan has gone on far longer than any rational human could possibly defend in terms of their policies and how their currency, the yen, has behaved in response to those policies. The yen literally should be approaching zero right now, but it doesn't. It keeps mysteriously strengthening, and it's all because we have a world financial system that is now run entirely by, of, and for speculators. They're awash in liquidity. They don't care if Japan has a long-term basket case. They care if they can actually, do a yen euro cross, carry the yen at zero, get a few extra bips off of the euro side of the trade, hedge it all out. It doesn't matter what the underlying fundamentals are. If you can make money at that, they will. That's the game the Fed is enabling. That's why the economy is not taken off, because the money they've put in has gone into speculation, hasn't gone into productive enterprise. No, just pick up a book about what was going on in Rome when they debased the denarius from 90% silver content to 0.02%, as they figured out how to electroplate lead slugs with a silver coating on the outside. Very clever for people without electricity. It was awesome. Good chemistry, right? But while they were debasing their currency like that, the period of history was just awash with people who were speculating. They weren't building productive enterprises. They would rather gamble and on the currency devaluations and make money that way than build something. Speculating's easy. Building is hard work. We're awash in an era of easy right now. That's what the Fed and other central banks are missing, is you can't build prosperity by enabling speculating. I don't know how they missed that. It's historical and it's common sense. It's just dumb.
Yeah, I completely agree. And very little of that over $30 trillion in currency swaps has gone to benefit anyone on Main Street in terms of value creation or job creation. It's gone mostly to asset bubbles and speculation and things like you mentioned before. So basically, going forward, I think we're going to see a lot more volatility in asset markets as long as these injections of liquidity keep increasing. The markets are just going to be more and more head scratching for people with, the moves in the oil price up and down, the moves in currencies up and down. Especially the moves in currencies, Chris. These things are unprecedented. A 2% move in a currency in one day or 1 week was unprecedented in the past. Normally, you'd only get a 1 or 2% move lucky in a year or two. So the interventions, I guess these governments, these central bankers are trying to manipulate their exchange rates on their currencies.
Well, they are. And of course, everybody can't manipulate their exchange rate lower. So there have to be backroom deals being put in place so that the central bankers at least know what the numerical targets are that they've all agreed to. If we actually got into an honest to God legitimate currency war with, say, Japan and China both absolutely, doing everything they could to assure that their own currencies were lower than their partners, we would be seeing very different dynamics out there right now. The movements really speak of some heavy-handed intervention. There's a lot of coordination, but now we have to default back to the larger view, which is it possible for probably 100 people, which I'll sort of add up the ruling bodies of the main central banks, 100 people. Is it possible for them to steer a global economy through their incredible wisdom? The answer is no. They can make bubbles happen. They're very good at that, and we're all aware of it. This all ends really badly, I hate to say, and I wish it had sort of come to a natural conclusion in 2008. Would have been very painful. People would still be miserable about how it happened, but now I feel like we're another 10 steps up the extension ladder, and the painful fall has now turned into a potentially fatal fall. It's just a much higher distance to begin our journey back to Earth. So I'm a little worried about all this, and I'll tell you that was my key takeaway from the wealth conference I just came back from, was that, hey, big money's worried now too. I don't think it's too far of a leap from worried to panicked when you get to this sort of stage of the story.
Yeah, if we go to the SDR, that's going to be even more inflationary, just like Bretton Woods was. Bretton Woods was a lie about how it would make things stable. It was very, very inflationary. Henry Hazlitt was out there championing against that. The stuff that they're discussing behind the scenes, their central bankers talking about going, to full digital blockchains with their currencies. That would be another form where they can hide even more inflation. So, they just won't allow nature to run its course and correct and have some type of deflation when that's what, markets want. They want to purge out the bad debt, the malinvestment and things like that. Now, Chris, speaking of malinvestment, I want to talk about the oil market and the shale oil market, since you are an expert in that. You've covered that probably better than almost anyone else out there. Why didn't more shale oil companies go bankrupt when the oil price got below $40 a barrel?
Well, a number of them had reasonable hedges on. Many of them are actually insolvent at this point in time. Bankruptcy is a legal proceeding. We're still waiting for those shoes to drop. We've had quite a number of them, but I'm expecting more. And here's why. Many of them were cash flow negative, free cash flow negative back in 2013 and 14. And that's important because oil was $100 a barrel then. Oil's chasing around the $43 mark as you and I are recording this right now. These companies, a shale well, you drill it. It has an initial production, if you're lucky, of 1,000 barrels a day. That's an awesome one. They average about 400 barrels a day, and then they deplete 85% in just 3 years. So if you drilled these things under a capital program in 2014, saying, wow, oil's 100 a barrel, I can make the numbers work, I'll borrow some, let me drill this well. You put it into production, and next thing you know, oil falls down into the 30s and 40s. That capital was committed when oil was 100 a barrel. There is no possible way for that capital to be repaid. It's been betrayed. You can't repay that with oil at 40. Don't look past the stories of we can get oil out of the ground at 40 now. Mostly that's not true. It's true for a couple of sweet spots, but on average, it's not true. On average, it's true that I think these companies could get oil out of the ground at 60 to 70, depending on the play. On average, there's few sweet spots, totally different for the horizontal drilling programs. So these companies, Jason, they drilled under a very different set of price circumstances. They committed capital under those price circumstances. Those prices are gone. That capital's been betrayed. Every week they pump a well that was supposed to be producing at 100 barrel an oil and is now producing at $40 a barrel oil. They're losing, they're burning that capital in each one of those barrels it's produced. That's the situation we're in. I'm expecting even more bankruptcies as we go forward.
Yeah, we've had about, I think, 60 bankruptcies so far this year, and another 50 or 60 last year, but that was nowhere near the amount of oil companies I thought would go bankrupt. Some of the stories I've seen, we just haven't seen a lot of these banks, Midwestern banks, large banks, call in loans. So what they've done is, they've delayed the loan payments for the oil producers. They've been able to go out there and help the oil companies, raise more shares. And things like that, especially on this oil rally. I think at least part of the oil rally that we had from 29 back up to the mid 50s was, financial engineering. So the banks didn't have to close out their bad loan portfolios, because I don't think they have any loan loss reserves for the subprime auto loan bubble, for the shale bubble. So I think, if they don't have to declare the bad loans and they don't have loan loss reserves, it's not an honest system where, the companies that are producing, the banks are just going to let them keep on producing and pretend they're not bankrupt, even though they are.
Well, that's absolutely true. They had a bunch of loans that are supposed to get reset twice a year based on reserves. They whiffed on that in October of last year, and then again in April. They just didn't reset those loans, so they left the lines of credit open, which was very generous of them. So that's just a fingers crossed and a wing and a prayer, Jason. That's like, please let the oil price come back up so we don't have to look at this. And the second thing, though, that surprised me a lot was the number of companies that were able to take their debt and convert it to equity. So they would go out and do another equity raise, as you mentioned, and then they would roll those new funds and use them to retire debt. I'm a little surprised because I thought equity investors would be smarter than that. That's really the riskiest play there is, to take debt that couldn't be serviced and say, oh yeah, I'll buy that as an equity stake, which has an even lower position on the rungs of dissolution should it come to that. So I was a little confused by that. But listen, we're in really frothy markets where pretty much anything gets bought, but greater fools and all of that. Good luck to the people who bought the equity issues of companies that couldn't pay their debt. That you're really crossing your fingers and hoping for a very big sudden turnaround in the price of oil. That's what that represents. There'll be more than a few burn fingers on that one.
Yeah, normally when a bondholder gets to take equity, it's normally after they realize the company's going to go bankrupt and they'd rather get, 10 cents on the dollar or 5 cents on the dollar and get some equity shares instead of getting nothing. So it is very surprising, like you said, to actually see that. Another thing I've noticed is also, like you said, the costs about the oil companies. They were playing kind of the same games the gold and silver miners were playing many years ago, before the gold and silver miners came out with all-in sustaining cost numbers. So when I speak with people in Houston and Dallas, jealous about the oil market and the cost and how much money they should be making. They talk about lifting costs. Oh, this shale company can lift oil out of the ground at $10 a barrel. Yeah, it's not counting at least 6 or 7 of all the costs that go into running the company, including, SG&A and capital costs and transportation costs of the oil and so many other things. So for you saying you produce a barrel of oil, shale oil for $10 a barrel, it's not even 30% of the total cost.
Well, yeah, that's absolutely true, and it's really tricky to get the all-in sustaining costs out of these companies. I agree. There's certain wells out there. If you said, I'm just going to buy this one well, and it's producing at volume X, and it has maintenance costs of Y, I can calculate all of that. Look at my cost for transporting that oil to market, understanding the grade of the oil and how that might factor in, put all that in, and say, yeah, I can. Some of these wells, if you bought just the well, you could actually get by with oil $10, $20 a barrel, and they'd be okay. But typically you're buying into a company, they have a portfolio of wells, they have SG&A, and these maintenance costs are not insignificant. If you have a big horizontal well that's down to, I don't know, 10 barrels per day or something like that, not bad. But every time you have to do a rod job on these things, you're out 80 grand and so on and so forth. There's just a ton of costs associated with getting this oil up from maybe 8, 9, 10,000 feet under the ground to the surface. It's heavy. Gravity's gravity. It costs money. So there are wells out there, and I'll be honest, I found some companies with shallow wells in the 800 to 1,000 foot range. They're not producing huge amounts, but the wells are very cheap to drill. I've looked through all the financials. They still make sense under today's circumstance. I'm not saying there's nothing out there. But for the companies who are in the weak part of the plays, drilling really expensive, big, long horizontal things way deep down, people need to look at those very carefully because the cost to get the oil out of the ground is a very difficult number to get with any confidence out of these companies.
Yeah, I think long term in the oil market, we're going to see a lot of volatility. We've had over $200 billion in capex cuts in the last year and a half. So long term, there's going to be consequences for replacing reserves. Demand hasn't really collapsed in the oil market. It's over 90 million barrels per day of oil, and there's still, a lot of depletion of these older fields. So I think, in the short term, it looks like there's an abundance of oil with the oil and storage and things like that, the numbers that we see coming out. But that's in the short term. In the long term, 5, 10 years from now, there's not going to be the investment made to replace a lot of that oil.
Well, that investment has already not happened, as you've mentioned, and it's continuing to not happen. 2014 and 2015, we saw less than 3 billion barrels of new reserves added each of those years. We, of course, burned or took out of the ground, produced, and then burned over 10 times that amount, 31 billion barrels per year. Is coming out of the ground. So listen, if you're in an industry that's all about reserves and you're replacing your reserves at about 10% of the burn rate, sooner or later you have a problem on your hand. That's part one. Part two, these older fields, North Sea fields, say the Cantarell in Mexico, a lot of the Middle East fields that were drilled in the 30s, 40s, to keep them pumping, as you know, Jason, and I'm sure your listeners know, you have to keep doing maintenance. There's infill drilling, there's additional injection wells that you have to service and drill, and all of that. There's costs involved with squeezing the last oil in place out. Not that it can't be done, not that it can't be done profitably, but without that sort of maintenance, your decline rates really skyrocket. And we saw this year, for the first time, that the estimate for the 2016 decline rate for existing fields is going to be approaching the 6% mark, mostly due to delayed, deferred, and even sometimes canceled maintenance. So yes, 2018 or so, I think that all of this, oh my gosh, there's too much oil, all that talk, it swings fully around and goes the other direction. The only asterisk I add to that statement is unless we get a major worldwide global recession, if not depression.
Yeah, if demand were to fall a lot. But I think one of the things that a lot of technologists are saying in Silicon Valley is, our goal is to replace oil in 10 years or less. I just don't see that happening. I think there's technologies maybe 10, 20, 30 years from now that are capable of reducing our dependence on oil and fossil fuels. But I don't see all the necessary allowance for many governments to allow it in terms of red tape and regulations. Like there's the liquid fluoride molten salt thorium reactor. In the 1960s, that could have been implemented. Instead, it was intentionally blocked for many decades. And now China is the one who's doing most of the research, and they're still probably at least a decade away. So I don't really see what the people like Elon Musk and the other Silicon Valley people are seeing that oil can be so easily replaced.
Well, they're smoking a big bowl of hopium is what's happening over there. Listen, we've had many years of increasing fuel efficiency in the fleet, and everybody says, look, this is a trend. Chris, just track it. The fuel efficiency of the fleet is going up, up, up. I don't ever pay any attention to that. It takes so long to swap a fleet out. And I'm confirmed because I don't know if you saw, but Robert Rapier and Forbes just had an article out a couple days ago that the Energy Information Administration, the EIA, released its most recent short-term energy outlook, and it's calling for record U.S. gasoline consumption this year. Already the first 6 months of this year, never has there been a higher 6 months of gasoline consumption in the United States. That's a record. That means we're burning more than ever. So fuel efficiency, it's a wonderful trend. Note it. But if the price of oil goes down, people burn more of it. And that's still the dominant trend by far. Love the technology, but the people in Silicon Valley, they got to get some pencils and napkins out and start, doing some numbers. It takes a lot of efficiency swap outs to make a dent in the overall consumption profile.
Exactly. And I think the people in Silicon Valley, they get so much money raised, they just totally ignore reality. And they have, the Steve Jobs reality distortion device. I
Yeah.
think that's very common there. I think that's very common there, especially when you can raise millions or billions of dollars so easily there without, a real business plan for a lot of those companies. But I just don't see a scenario where the global population seems to me, unless we have a world war or people, all of a sudden just stop having kids at all. I just see the world population continuing to grow, and as more people, grow, as the world population grows, people want more and more nice stuff. They want to be their version of a middle class. So, if they were in China in the 1960s or 70s during Mao's era, they had, one or two wardrobes of clothes, and they had to ride bicycles to work. Now they want scooters and motorbikes and small cars and things like that. So that's a whole, new set of demographic that's consuming oil, even though it's more efficiently than here in the U.S. with SUVs. They're still using scooters and electric bikes and things like that.
Well, absolutely. And the most frightening statistic I heard was that in about 2010, there were 1 billion people considered in the middle class across the world, and that by 2025, that was expected to go to 3 billion people. So a 200% increase in the number of people in the middle class. And as you mentioned, people in the middle class consume a lot relative to other people. So listen, anybody who thinks gasoline demand is falling has got to go driving with me. When I was in Lima, Peru, worst traffic I've ever seen, except for Mexico City. That was even worse. But it was really awful in Beijing. I mean, wherever you go, there's just people driving everywhere. And I make a habit, Jason, of looking at how many electric vehicles do I see? And the answer is usually zero. In the United States, I'm starting to see more Teslas, but here in New England, it might be one a week. In California, you might see 3 a day, but you might see 300,000 other vehicles or whatever the number. I mean, it's just they're very, very small. I'm waiting for them to make big inroads. I'm hoping for super new battery technology, inroads to be made. But people, we got to be realistic about this. If you want economic growth, you're going to have growth in petroleum consumption, period. So either the economy grows and we run into a supply problem on the petroleum side, or the economy falls, and it does what it usually does when it falls. It makes a big disaster in the financial side. My view, Jason, that you can't have infinite growth on a finite planet. We're going to have to wrap our arms around that. Petroleum is kind of a good way to get into that story and begin to talk about what I consider to be a pretty simple set of facts.
I actually want to talk about the limits to growth. Now, Keynesians, the way Keynesian economics and neo-Keynesians and stuff like that have said, we can grow infinitely. The Austrian school says, no, we can't. We have to have a recession. We have to wash out the bad investment. Things can't grow unlimited amounts. I think, the Austrian school is more based in nature, more based on common sense and grounded in reality compared to Keynesian economics and some of these other central planners and people that think that they can ignore reality and just do whatever policies they want.
Well, absolutely. Listen, it's just the most baffling thing to me to talk to these economists who insist that infinite growth is possible. I really just need to get them outside and just point at trees and stuff and have them understand, just nature. There's a limit to all of this. And of course, there's a limit. And we're starting to see those limits. And even when the limits hit, though, it really doesn't impact somebody with a deeply entrenched belief system. They just won't get it, So the Ogallala Reservoir aquifer under, Oklahoma and Kansas is so depleted now that farmers are having to revert back to dryland farming. It takes their crops down to half or less. And people out there will still say it's some sort of a conspiracy by environmentalists to limit. No, you depleted this aquifer that takes 10,000 years to recharge at 6% a year and you ran out. That's That's how that stuff works, right? So we're going to have to confront that at some point. And this is the reason why I get passionate about this, is that unless we in the United States, other countries can worry about themselves, unless we figure out that oil isn't infinite and that we're going to end up someday in an oil less future, not completely zero, it never does that, but it'll just start tapering off and be going the other direction. We're going to have to do some really big things around transportation in particular, but also around fertilizers and plastics and other things that are derived from petroleum. We're going to have to really think those issues through in terms of how we want to manage that transition. And we're not, it doesn't feel like we're going to, because the keepers of the status quo have insisted that we not talk about that because now's a bad time, or they don't believe in it, or something like that. But the data's simple. If we don't do it, it'll happen to us and we'll be unhappy with the results. It's just like any company that fails at strategizing. You have some competitor that comes along and cleans your clock. Unfortunately, in our case, this competitor is nature.
Chris, I think the free market could fix a lot of these problems. I've spoken with, like after the Fukushima disaster, I spoke with a algae entrepreneur who said that the technology was there to go do phytoremediation, grow greenhouses right around the plant, and use algae to fix the water and the soil, and over time that would drastically reduce the radiation. A lot of these solutions were ignored. You brought up the water problem. I think the water problem could be fixed a lot. Obviously the water tables take a lot of time to regenerate, but I think, desalination and these problems could be solved more efficiently by an entrepreneur in the free market rather than big government projects for billions of dollars. I think one of the things they would have to do, though, is the consumer would have to understand that for a while the water price is going to be higher, for the incentive there, so the entrepreneurs can raise the capital, invest the money in the new technologies for water technology, and then over a decade or two, the free market would solve those problems of clean water. The cost would initially be higher, so the capital investment, the capex of these technologies, but then the problems I think would get solved. But I don't think that's being there. When I speak with people in the municipalities in the water industry, they tell me they don't want to make investments because the state government of California or so many of these other governments are telling them that they can and cannot raise the price on certain groups of people. The rich are going to get a 25% surcharge, but the poor and middle class can't pay any tax increases. Well, why are they going to invest in any new technologies that would solve the problems then?
Well, it's absolutely true that we could have a lot. We have a lot of solutions out there that could be applied right now that we're not doing for a variety of reasons. And you mentioned some of the most frustrating ones, which are brain dead regulations and things like that. Which guess what? That's part of life. But there are other reasons out there that we're not doing things, and some of them are just frankly dumb. We don't do them because we don't do them, right? One of the classic examples that I put up is solar thermal panels. The sun heats stuff up, great. It's harder to turn it into electricity. That's a dodgier proposition, but it heats stuff, great. Put your hand on your car on a hot day and you'll figure it out, right? So heating water with the sun, it makes environmental sense. It makes economic sense. Fantastic paybacks on these things. They're very simple systems, so they can be designed, built, installed, maintained locally. We don't have to buy these fancy systems from China like we might be buying thorium reactors in a couple decades. It just, they make any dimension you care about, local jobs, national security. I can make a case for these, and we don't do them here. Other countries mandate every building that's put up has to have solar thermal because they just make complete sense. If you don't heat your water with the sun, how do you heat it? Well, with an electric heater, with a gas heater, with an oil heater. One way or the other, you're using fossil fuels to heat water. It's just dumb. It's dumb. But we still do it. So really, it's not a failure of markets. It's not a failure of the ideas, not being compelling and across multiple dimensions. It's literally a failure of our narrative. We don't do that in this country because we don't do it. And that's it. So that's been my work, is to try and make the case well, why wouldn't we do that? Doesn't that make sense? If we don't use fossil fuels to heat water, we can use them to do other things, like build the new energy infrastructure out or whatever it is we're going to do with it. But we're not going to use it to do something dumb like heat water when we could get that done for free practically by the sun. That's the level of failure of imagination that I confront on a daily basis.
Yeah, I think the people on Main Street are going to have to do a lot, and the small business owners and entrepreneurs are going to have to solve a lot of problems. I think the bureaucracy now is so entrenched. I just don't think they're going to make it so hard for many entrepreneurs to solve their problems. So the people on Main Street are going to have to figure out ways to protect themselves, whether it's with their money or saving money at their house or investments or things like that. I have one more large, big picture question for you, Chris.
Mhm.
I actually came up with this question in 2013 for you, and I haven't had a chance to ask you this one. So many experts cite the Simon Ehrlich wager from 1980 to 1990 as justifying that over the long term, all commodity prices have to fall. But despite what economic textbooks say should be happening, things have drastically changed since China joined the WTO, and commodity prices are nearly all in long-term uptrends, and the cost of production for many commodities rises 10% or more yearly. What type of real-world limits are there preventing commodity prices from declining over the long term that maybe was not seen or not available when this bet was made?
Well, so commodities is just too big of a term for me to really get my arms around, because each of them has its own dynamic. Look, everything is supply and demand at some point. So if you have something where you can reasonably and quickly expand supply past near-term demand, pricing is going to do what it does. It's going to expand out to the marginal cost of production, and that's about it. And so that's how I would call farming, right? There's still plenty of farmland in the world, and we have plenty of industrial fertilizers to put into the industrial agricultural process. So understanding grains is a very different prospect, say, from understanding indium, gallium, rhodium, super rare metals, not rare earths, but super rare metals that are highly needed, non-substitutable in the industrialized economy we want. And those are things where you look at the prices for those, and those are driven by a completely different profile, which is that they are in very short supply, likely to be an increasingly short supply going forward. Into that group, I'll throw silver. There's a variety of commodities out there whose supply-demand characteristics are completely going to be in a long-term uptrend, if not going to infinity, as it were, because when they become unavailable, because there's none, literally none left. That's the part of the story we're in right now. And if you believe we're going to have an industrial economy going forward, I would highly encourage people to look into some of the base raw resources that those industries will need. Listen, you could always get burned because somebody figures out substitution in a way that takes a key metal out of the supply chain quotient. But for the most part, it's not that hard to find really key inputs that we need that you cannot make a strong case for anything other than they're becoming more rare, more dilute, more distant, more difficult to mine, and therefore more expensive. And as you mentioned, the cost structure in the mining industries has been very, very high. And a big reason for that is that they are very energy intensive. Mining uses about 10% of the world's yearly energy consumption, which makes sense. You've been to a big mine, I hope, and you've seen like a giant open strip pit mine, and you think about how heavy all that earth must have been to move the overburden rock as we went down to the ore. You understand it takes a lot of energy, not just to mine it, but then to crush it, smelt it, whatever else you're doing with it. And let's try to remember that it was 1998, oil was $10 a barrel. It was 2005, oil was just 20 some dollars a barrel. People at that time were saying, oh, if it ever gets to 50, it's lights out. Turned out it could go to 150, and it wasn't exactly lights out, but it was crisis time. And now oil seems to be structurally about twice as high as it used to be 15 years ago. And you and I think would agree, we could look forward and make a case it might be twice as high now as it is today, and then as it is today. So that dynamic of increasing energy costs in the petroleum side feeds into the mining side and becomes part of that story. So yes, I think that that famous Julian Ehrlich bet is going to get revisited, and in 20, 30 years, we're going to have a very different view of that.
Yeah, I think, the economic textbooks say that, over the long term, commodity prices should fall, but we haven't seen evidence of that. We've seen costs rise because of scarcity of the earth is finite resources. And yes, there'll be substitution. And in a couple decades, I'm sure there will at least be some type of attempt, maybe with robots or something like that, to do some type of asteroid mining. It's obviously being discussed. and that would create more supply for things like platinum group metals, platinum and palladium and things like that. But I don't see that being cheap to mine things like that. So I just don't see a solution out there where the economics textbooks are going to be proven right, where the price of these commodities are just going to keep falling and falling and falling, at least not without removing quality. Maybe in the food sector, the finished food products, some of the food prices have stayed kind of cheap, although there's inflation, but you can still get relatively cheap food, but the quality, the vitamins and stuff of the food has been, just completely stripped out of it.
That's a great point. And so if you really did a full adjustment on food, not just the hedonic adjustment where the government assumes everything's getting better at all times, but you did the reverse and understood there's a negative adjustment that has to be made for food. If I want to buy high quality food, it is not cheap, and it is much more expensive than it was 10 years ago. And not just organic, but I mean high quality, locally produced, grown on soils where the soils have the appropriate macro and micronutrients, where the people are tending the soil first and creating the awesome crop second. That's not cheap food, and it shouldn't be. It's really much higher quality. So you get what you pay for. Yes, you can buy a couple of hot dogs and some mac and cheese pretty cheap out of Walmart, but that's not a high quality food. And so high quality food's getting more expensive. My prediction, it's going to get even more expensive because let's face it, we're having increasingly chaotic weather. I'm suffering through a really bad drought here in New England right now. It's just been wonky for a while. Wonky weather and farming are bad bedfellows. And I think we're going to start to see more of that playing out over time. So not just stressed harvests, but also decreasing overall food quality. So I'm actually very bullish on the food movement, food investments that are out there. I think there's a lot of good things, but the big ag model is probably not the place. It's definitely not the place I'd start.
Yeah, I agree. I've actually was looking at starting an organic farmland real estate investment trust because I follow the work, of Joe Saladin, and you interviewed someone else about organic farmland real estate investment trust. I think that's a good idea. So the supply of, higher quality food can maybe lower the prices. So middle class people could afford higher quality food then at a little bit lower price than they're getting right now, because a lot of people can't afford to go to Whole Foods and buy every single meal from there, buy the supplies there.
You mean whole paycheck? No,
Yeah.
no, I know it's very expensive, but for people who want high quality food and care about giving their family high quality food, it's expensive. It is not unthinkable for me to come out of Whole Foods with a single bag of groceries that's set me back $100. It can happen. It's amazing.
Yeah, and yet, for people to get healthier, they have to, I changed my diet last year. I was really, really sick because I was eating too much processed foods and I was eating too many carbs and grains. So I went paleo and I lost 25 pounds, and, eating organic food, eating leaner protein that was healthier and things like that, it helped me out, but it's not cheap. And unfortunately, in the world we have now, people are going to have to change their diet, because if you eat the cheapest food, you're going to get sick very, very quickly now.
Yeah, so let's define cheap. It's cheap to eat the meal, but it's expensive as your health deteriorates over the long term. So I actually think expensive food is worth every penny. If I'm not inflaming myself and otherwise eating foods that are clearly shown to have a really negative impact on health, whether it's just through the accumulation of fat, or it's because they're inflammatory, or it's because they actually lack the appropriate macro micronutrients, or it's because they're contaminated with something. That's one of the things I really regret, is that it's hard it's just complex. I mean, even my cable bill is too complex to really understand. My phone bill, forget about health insurance and understanding really what I might or might not be covered by in the inch thick booklet that comes along with it. But food shouldn't be this hard. Food should not be one of the things you have to worry about, but unfortunately it's on the list.
Yeah, and you brought up a great point there before we wrap up about how complicated everything is with the bills. I think that's part of, this complicated system that's been set up by the large corporations with the government and the government agencies. It's a complicated system of inflation and taxes, and most of the people in Main Street are just getting screwed more and more every year, unfortunately.
Well, it is, and it's that being screwed through complexity, and it's just part of it. People are worn down. They're tired of all this complexity. It shouldn't be this hard. Of course, it's hard for people like you and me and everybody listening to this. Of course, it's easy for the elites who skate off, whether you're a Corzine or a Clinton or a whomever. These people who routinely violate what clear to be spirit and letter of the law and skate off with it. It creates injustice. And so, we're primates, and primates hate injustice. It's part of being a social creature. In fact, all social animals are shown to have strong penalties for acting out of integrity within the social structure of your group. And we're really lacking accountability and integrity at the highest levels right now. And that's unfortunate.
Have you had a podcast about that? I'm curious if you could go in depth more about that. That sounds pretty interesting. I've read books about psychology and brain books and history of human beings and things like that. That sounds pretty interesting.
Well, I'll tell you, you could probably get everything you need to know from a 2.5 minute video clip. You can find it on YouTube easily. Just type capuchin monkey, capuchin, Capuchin, capuchin monkey grape video, grapes. All right, just check that out. Best 2.5 minutes you've ever spent. And if you don't recognize yourself in that video, you haven't been stuck in the same traffic jams I have.
Okay, well, I haven't watched the video, so I can't tell you if it's true or not, but I will take a look at that. I just want to thank you again for your time, Chris. I enjoyed this discussion. You're one of the few experts out there I can talk with all these different topics and, not get lost. So you do a great job. I really enjoy the crash course and your updates on that. Keep up the great work. And how can our listeners find your work and also your book?
Well, fantastic. Thanks, Jason. Likewise, I really appreciated this discussion. So Peak Prosperity is the website, PEAK, Mountain Peak. Peakprosperity.com. Yeah, we've got a subscription service, a lot of free content, a whole community of curious people. The latest book is called Prosper. You can find that on Amazon, at our website, bookstores as well. And that has financial capital as one form of capital, and it details 7 other forms of capital you need to have if you want to be happy today and prepared for the future. Things like emotional capital, social capital, knowledge capital, things like that. So we start with money, but we broaden it out very quickly because the future we see is going to require a lot of different, a true basket of diversification, I'll say. And so that's the work that we are doing now.
Excellent. Well, keep up the great work, and I hope to speak to you again soon.
Likewise. Thanks.